welcome to Anew Advisors webinar education series. Thank you for joining us today. My name is Liz Notley, and I am the Director of Operations for Anew Advisors. Today, our webinar will be focused on the economic review of the first quarter of 2023. We do have Glenn Colwell and Nick Schneider here that will be presenting this update. And just a few housekeeping things before we get started. Today's webinars will be recorded. During the presentation, you may ask questions via the chat button. Otherwise, we will have a question and answer at the end of the session. So without further ado, please welcome Nick and Glenn.
Thanks, Liz. I appreciate that. As you've seen in the previous slide, our disclosures and all the boring announcements, but Liz makes it so much more palatable with your voice. So thank you, Liz, for introducing us and my colleague, Nick, on here as well. We're going to go through a few items here today. We'll touch on who we are, although everyone typically on this webinar knows who we are, their current clients. We do have some prospective clients dialing in, so we'll touch on that briefly. Formal rollout of our monthly education events. So you'll see a calendar. If anyone wants an email after this, please shoot any one of our business director officers, whether it's Sean Lauda in charge of law enforcement or Mike Bongiorno in charge of fire services. If you want to copy our monthly education events, we also do financial training. And then we'll touch on quarterly market update. Nick's going to run that portion, and then next steps. We always share our mission, vision, values. I know a lot of companies post this on their website as well as we do. I guess for me, most proudly is our value component. We display a lot of grit, and that's a term that I use a lot within our team meetings. But what I will tell you is that I'm really proud of our team and the grit and the future thinking that we provide. We all test each other, make sure we're holding each other accountable for the benefit of our clients. This is my 23rd year in the business, and had the good fortunes of working for many large companies across the country in both financial services as well as investments and insurance, and bringing that expertise to start my own firm, along with joining with my partner, Anthony Zilli, and then the rest of our team to really have a great focus on first responders. So collectively, across the investment experience between Nick and myself and the rest of the teammates, we're pushing 60 years of experience. I know that's typically a huge selling point for maybe large firms or big box firms, the amount of years of experience. But the reason I think for us that it's so imperative that we talk about that is because we have a dedicated focus with first responders. So it's not just about the investment experience. It's also about understanding the goals, needs, wants, and desires of our clientele. This is our 2023 education calendar. We've provided education month by month over the last several years, but we really took it upon ourselves for best practices to publish it now. So if anyone, again, does want a copy of it, please shoot us an email and we can give that to you. So as you'll see, in April, we're doing our quarterly market update, which is now. And then in May, we'll have an email blast go out for our 8 steps of summer financial checkup. And we'll also do a Zoom in our roadmap. Roadmap is our key experience for our clients and our prospects. It really provides each particular individual and or family a custom roadmap that includes anything you want it to include: investments, income, expenses, goals, etc., and it's customized to you. So hopefully you all tune in next time and see how this exactly works. And then June, we are highlighting the 457s, which is a retirement plan specific to public safety through their municipality. So we're going to go through the ABCs of 457s. And last but not least, we're going to jump right in here. So I hope everyone tuned into the news this morning or their favorite website and got the crisis du jour. It seems like we're just constantly inundated with fear. And what we try really, really hard to do for our clients is set that aside and help them understand what A, is really going on in the economy and the market, and B, how it's really impacting your portfolio. And not just trying to sell fear and greed. The news channels or the media or the webinars or blogs do a really, really good job of that. And what you're constantly seeing in the news, whether it's the Ukraine war, inflation or bank crisis. The new one this morning that I love on the headline was "Get ready for earnings recession," which was just a fancy way to talk about how the pros or the economists or the money managers expect a slowdown in companies' earnings, which we're gonna tackle that particular question as we get through this. But separate yourself from the news. If you log in or dial in or turn on your TV, the only way they're selling commercials is through fear and greed. So just try to put that aside as we go through this. And I will have Nick take over and go through some of the economic data.
Yeah, so like Glenn said, the news really wants to try to scare you, and we're trying to let you know what's really happening right now, first in the economy, and then we'll jump into a little bit of the market. So what you're looking at, this first slide here, is what the actual economic growth in GDP has been. So with that dotted blue line being the trend and what the government kind of shoots for in 2%, the gray line is what's actually happened. So yes, even though there was a pandemic blip that we knew about, we recovered very quickly and we continue to stay on that trend line. So even though the news wants to scare you, our economy is still growing. And what it's driven by and what we've really held to is you're going to see on the right-hand side, the components of that growth. And you're going to see that about 70% of that growth is consumption. Liz, can you go to the next slide? The reason we believe that GDP will continue to grow and the economy will grow is because the American consumer is going to continue to consume. Between baby boomers and millennials, there's no other demographic like it in the country. So even though there's things going on like the Ukraine war and Russia and China, our demographics are going to be able to continue to push consumption and push our economic growth where their populations won't support it. Next slide.
Yeah, the only thing I would add to this slide, Nick, is you know, the U.S. consumer is trained to spend money. I always say that, and you can witness that around you if you go to any particular venue, whether it's airports or cruise ships or train stations or restaurants, whatever it might be. The U.S. consumer spends money, and they've dug ourselves out of many, many recessions in the past, and they will continue to do so.
Yeah, so thank you, Glenn. Next, we're going to tackle inflation. This has been another big one with the Fed rate hikes and what inflation's been. Some of the scary numbers last year for headline inflation, you know, 9% is what we capped out at, but for food and energy at one point last year, it capped out around 11 or 12%. But what you're seeing at the very end of this chart is that inflation is starting to come back down. The Fed raising rates, supply chains loosening up. We are seeing inflation trend back down towards that 4% average number. And we think that it'll get back to that point. So even though it can be a scary number when you see it on the news, it's moving in the right direction. Next slide, Liz. So what does this mean, right? A lot of people, you know, when they hear economy, they think market as well. And although they're different, they're often related. And people will use the economy to create fear and volatility in the markets. So what you're at here, this chart is how people have felt about the market. And for the purpose of this presentation, we say the market, we're referring to the S&P 500. That's the big stock market index that people often refer to. So that's what we're going to use for the presentation here today. And what this is showing is how people have felt about the market at different times and what it's done after some of these highs and lows. So when we feel really good about the market, typically returns aren't as great. The best returns are often had when we're scared and we're fearful of what the market's actually going to do. So if you look at the 8 lowest points on this chart, the average return once we've hit that bottom is about 25%. So even though you might be afraid right now, there's value in being able to stay the course. Next slide, Liz.
Well, sorry, can you go back one? I just want to mention one thing. If you look at the far right where we are now, March of 2023, if you look back at like February, that was at the lowest consumer sentiment point, even further than 08. So think about that. People on average, investors on average, were more scared or more negative a month ago than they were at the bottom of 08.
Yeah, so the next slide, Liz, we're going to show what actually happened. So here's what the S&P 500 has actually done regardless of what the sentiment is. This is the reality of where the markets actually return going back to 1995. So this is over about the last 25, 30 years here. You're going to see that we've had a lot of these peaks and troughs and we've had a lot of volatility, but even starting from 08, we had the major bull run of up 400% going all the way to the pandemic that ended that last big bull run. And then even after the pandemic, where we had that 34% decline, we then jumped back up 114. And yes, we are in a little bit of a trough now, but as you can see, the markets continue to move forward. So regardless of how the news and media want you to fear, the actual companies themselves in the index are doing well. Next slide, Liz. And this is how well. And to just kind of add a little perspective, we're going to look at before the pandemic, right? Because now the news wants to talk about pre-pandemic and the post-pandemic world. Well, pre-pandemic growth for the country, the GDP was right around $22 trillion. And earnings per share was between $148 and $162. That's what those 2 points are talking about. But since then, now that we are out of post-pandemic, which seems like forever ago, GDP is at an all-time high of 26 trillion. So are earnings per share, and so are dividends. So even though the news wants you to make you think that we're in a worst case scenario all the time, the countries continue to grow, driven by the consumer. Companies are still having record earnings. So regardless of the earnings drought that they say we might be in, they're still at all-time highs, and so are dividends.
Yeah, and so much for that earnings recession headline this morning. So, it's not to say that every company in the S&P 500 is having stellar year, stellar record-breaking earnings, but the majority, the average are.
Next slide. And this one, I just wanted to be able to add in to give just a little more perspective about the market and the ups and downs that we see year to year. So what you're looking at, all these little red dots are the low points in any given year. So on average, at some point in the year, the S&P is down 14% off of its high for that year. The gray bar is where it finished on the year. So even though at some point the market's going to be down, we know that it goes up and down, but in 32 out of the last 43 years, the market's still finished up. And in any given year, the media wants you to believe that you're at one of these red dots. So if we go all the way to the end, you'd think every day the market was down another 8%, that you're living at that red dot. But the reality, the S&P is still up 7% this year. Even the major indexes are starting to have their bounce back. So even though, again, headlines very scary, right? There are a lot of things to be really positive about in the market and in the economy. And Glenn will cover those on the next slide.
Yeah, I would, again, just maybe back one slide, I just like to point out that 2020 pandemic, obviously, it changed the world and changed the way we interact. If you even look what we're doing now, we reach a lot of clients via Zoom across the country. It's really conducive to ease, and it's really conducive to utilizing the most current technology when we communicate with clients. And we're seeing clients prefer Zooms over in-person meetings. But the point of that is, at the height of that pandemic, we were down 34% in the markets, but we still ended that year up in double digits. So a little bit of patience, a little bit of understanding your strategy, a little bit of understanding what companies you own and how they produce results is always a good perspective. And so, every morning that we turn on the news, like I have a ritual. I get up in the morning and I watch a little bit of local news, and then I put on some national news. And lo and behold, you always see some particular major event happening or some crisis du jour. I would really love to be able to override them and chime in and talk to them about certain areas that are up, or certain things that are happening that are more positive. So the Fed is close to the end of raising its interest rates. They're giving hints to that, which bodes well for the economy and the market, because at some point, they will start lowering interest rates again, and they will start pumping money back into the economy, and which bodes well for the consumers and companies. The other thing I think that often gets overlooked is the manufacturing build out that's exploding in this country. If you look across the US, there have been announcements over 110 billion in new factories being built across this country. That is nothing but good, right? So maybe they don't get staffed as much as they used to in the past because of technology being used in these factories. You still have to build the factories, you have to build the infrastructure, the surrounding businesses around them benefit, etc. Will also help the supply chain being fixed and inventories. These are all good things for companies, which in return help boost up their stock price, which in return help the actual investor realize gains over long periods of time. The last part of this particular slide that I'm going to mention, which is a very key component to our investment philosophy, is dividends. Companies are having record buybacks in their stock shares. And when they buy back their stock, it makes their stock more valuable. There's less shares out there. They're also increasing their dividend payments. This is cash returning back to the investor. If you understand who usually the largest shareholders are, it's usually the key executives of the company. It's the financial institutions that own them. It's private equity. It's the C-suite executive. If they're willing to give themselves a pay raise by buying more shares and increasing the cash dividends back to them, that is nothing but a positive sign for them. So make sure you understand exactly how the company is earning their money and how they're rewarding their shareholders. Next slide, please.
There was a question in the chat. Did you want to answer that?
Oh, sure. Yeah, I didn't see
Yeah,
it.
we can answer that first. Yeah, so the
Is there
question
any reason
was,
is there any reason to be concerned about the chatter dealing with a possible pending debt default? I guess I'd like a little bit more specific about pending debt default. I'm assuming you're talking from the US perspective. You know, we're really good at printing money, if that's what you're referring to. So the US is going to raise the debt ceiling. They have to. There's too many implications to not doing that. What it really comes down to is maybe a more prudent fiscal policy. But every politician, whether you sit on one side of the aisle or the next, kicks the can down the road. And unfortunately, at some point that will take effect, but it will take effect in higher taxes. It's a revenue, right? It's just like a checkbook in your own household. You have revenue coming in through the paychecks or investments, and you have money going out in the form of expenses, and you have to balance that checkbook. I wish we as the average US consumer could just print money or just to continue to increase our budget without any really known revenue sources. But that's exactly what the government is doing, and they will continue to increase the debt ceiling. There's just too many side effects, if you will, for them not doing that. But expect higher taxes and expect inflation flows. One thing that Nick highlighted is our market cycles of the ups and downs are coming quicker because of the way our economy is built. It's global and it's technology based. The cycles will come faster and they might start and end faster as well. Hopefully that answered your question. This is key components of our investment philosophies. So for those clients that are on this call, you understand this. For those prospective clients, it's really three key components. When you look at investments, we believe in owning individual companies and not mutual funds. We don't necessarily want to own every company in the S&P 500. We want to own the companies that we know from a perspective are doing well, but they're doing well, and we want to take advantage of that. But we only want to buy that stock one time, right? We don't want to buy a mutual fund and have reoccurring internal expenses if we don't have to. We rather buy the stock one time, pay zero transaction costs, and hold that stock. So investment philosophy, point number one, it just shows you the inefficiencies of mutual fund expenses and what's being charged actually on the underlying, if you lift up the hood, the underlying investment expenses. Number two is we want these companies, as I mentioned, to be paying a cash dividend to our shareholders. If you look at this, this is third-party research by Ned Davis that we're using, widely used in our industry. This is not numbers that we publish. It looks at the S&P 500 from 1973 to the close of business of 2021. You get rewarded by buying companies that pay a dividend and grow their dividends. That's what that top line is telling you. You would have realized an annual rate of return of about 10.68% had you just held the companies in the S&P 500 that paid you a dividend and grew that dividend. It's a key component to our investment philosophy. And then lastly, as Nick has mentioned, why baby boomers and millennials? two largest generations in our country, the two largest generations in the world that make up that age range and demographic. That is buying power. Get in front of buying power and you benefit long-term. These are our returns. So we really kind of have two, what we call key flagship portfolios. Our dividend income strategy on the left, which is companies that produce dividend incomes and raise their dividend income over time. It's more of a cash flow income goal for us, for our clients. And then on the right-hand side is our technology portfolio. So if you believe, like we do, that technology plays a larger and larger role in business and personal life, like we're doing now, we try to take advantage of that through a technology portfolio. It does, provide more growth, but it is a lot more volatile, if you will. So we can do one or the other, or typically we do some blend of both of these portfolios, depending upon what the client's needs are at the time, whether if it's not just income, and it's not just growth, if it's an income growth goal to meet a specific expense or lifestyle need, we do blend these portfolios together as well. If you'd like more information on that, please reach out to our business director officers, Sean Lott on law enforcement and Mike Bongiorno on fire services. Open it up for questions. Please use the chat box. I don't see any questions. Maybe we'll just give another minute here. And then if not, what I would suggest is for those that would either like an update on their roadmap or would like a roadmap, custom roadmap built for them, again, please reach out to us. We'd be happy to do so. Appreciate all your time.